China is grappling with a series of serious challenges, from U.S. tariffs and allegations of unfair practices to a growing erosion of international trust. What is truly unfolding behind the flurry of diplomatic trips, coordinated media campaigns, and the ongoing wave of capital outflows from the world's second-largest economy? According to Reuters in April 2024, President Biden considered imposing tariffs of 100 to 200% on electric vehicles, batteries, and solar panels from China. This would follow the existing tariffs on over $370 billion worth of Chinese goods imposed during the Trump administration. In response, global businesses have accelerated their shift away from China-centric supply chains, redirecting investments toward Mexico, India, and Southeast Asia. President Xi Jinping has embarked on diplomatic visits to Malaysia, Cambodia, and Myanmar in an effort to maintain regional influence. However, Japan and South Korea have rejected the prospect of new cooperation with Beijing and have publicly denied reports circulated by Chinese media. Consumer Reports noted that many factories in Guangdong and Zhejiang have experienced a reduction in orders and have cut working hours. Exports to the U.S. account for more than 16% of China's total export volume, directly affecting millions of workers. Meanwhile, in the United States, prices for electronics and home appliances have risen by 10 to 20% due to the lack of affordable alternative sources. In 2024, China's exports to the United States reached $501.22 billion, accounting for approximately 14.7% of its total export value. However, many businesses have been accused of circumventing tariffs by routing goods through third countries. China also faces allegations of intellectual property theft from U.S. companies, with estimated losses ranging from $225 billion to $600 billion annually. Numerous copied products are sold at lower prices, significantly impacting revenue for American firms. At the same time, China is the subject of over 60 anti-dumping and subsidy-related cases at the World Trade Organization, reflecting declining confidence in the country's trade practices. The drop in orders from the U.S. has led many Chinese factories to scale back production and cut jobs. Job insecurity is spreading across major industrial zones, particularly among workers whose livelihoods depend heavily on export manufacturing. In the U.S., some domestic industries have seen short-term gains, but consumers are facing rising prices due to the shortage of low-cost alternatives. In 2024, China announced restrictions on purchasing Boeing aircraft. However, according to Reuters, President Xi Jinping continued to use a Boeing 747 for his diplomatic travels, highlighting a contradiction in the country's messaging. At the same time, institutions such as the European External Action Service have raised concerns about TikTok being used to disseminate manipulated videos targeting European brands. Chinese media outlets have also received low transparency and freedom ratings from international organizations such as Freedom House due to strict censorship practices. In the United States and Europe, trust in Chinese-made goods has declined significantly. Consumers are increasingly opting for locally produced goods or imports from countries perceived as more reliable, adding further pressure on Chinese businesses already struggling to maintain international market access. China has made efforts to improve its relationship with Europe. However, the spread of manipulated videos on TikTok targeting European brands has had the opposite effect. According to TikTok's year-end transparency report for 2024, nearly 10 million accounts and 460 million fake likes were removed from the platform. At the same time, Freedom House ranked China 172 out of 180 countries for press freedom, reflecting a continued decline in international credibility. Domestically, this erosion of trust has made it more difficult for Chinese companies to expand globally, resulting in slower growth and lower income. For international partners, Growing concerns over transparency in the Chinese business environment have prompted many to scale back cooperation and cut capital flows into China. China and its strategic move to challenge the dominance of the US dollar. No SWIFT, no USD. China is reshaping the way the world pays. Is the global position of the US dollar under threat? By the first quarter of 2025, China had processed over 18 trillion yuan, approximately 250 billion USD, in cross-border transactions using the digital yuan ECNY. This system is directly integrated with SIPs, which now connects more than 1,400 financial institutions across 110 countries, enabling fast, low-cost transactions without relying on SWIFT. The ECNY enables near-instant and virtually cost-free transactions. This advancement helps businesses reduce operational costs and shortens payment times. While individuals benefit from more convenient international money transfers for migrant workers in particular, the ability to send money home faster and at lower fees can make a tangible difference. Less money lost to fees each month and near-instant access to funds. This, in turn, can improve household spending and reduce reliance on traditional financial services. Moreover, those without a bank account can still participate in the financial system through the ECNY wallet, broadening financial access and inclusion. By the end of 2024, China had signed more than 40 bilateral currency swap agreements, with a total value of 586 billion USD. These agreements not only strengthen financial cooperation, but also improve access to financial services in countries with limited banking infrastructure, reducing reliance on physical cash and exposure to USD exchange rate. Volatility. The share of China's cross-border transactions conducted in yuan rose from 40% in 2021 to 53% in 2024. Within the ASEAN bloc alone, transaction value reached 5.8 trillion yuan in 2024, an increase of 120% compared to 3 years prior. For businesses, this shift lowers currency conversion costs and helps stabilize exchange rates for individuals. It contributes to curbing imported inflation and helps keep the prices of essential goods more stable. The digital yuan ECNY is also being used in Belt and Road Initiative projects, such as the Gwadar port in Pakistan and the railway in Laos, where it enables direct payments and capital oversight through smart contracts. Local workers receive wages via ECNY, allowing for faster, transparent, and intermediary-free payments, supporting higher earnings and reducing leakage. Currently, 13 BRI countries are piloting the use of ECNY. The rollout of the digital yuan, ECNY, is playing a growing role in reshaping the global financial system, especially as Beijing moves to expand the use of the yuan in international trade, following the United States' decision in April 2025 to impose a 145% tariff on Chinese goods. As of March 2025, the cross-border payment system, based on ECNY, had been connected with 10 ASEAN countries and 6 Middle Eastern nations. This network enables faster transactions, lower costs, and eliminates the need to route payments through SWIFT. According to the Bank for International Settlements, BIS, the use of central bank digital currencies such as the ECNY could reduce international transaction costs by 5 to 7% compared to traditional banking systems. The BIS also notes that access to financial services could increase by 4 to 6% in developing countries with effective digital payment systems. This shift not only helps partner countries reduce their dependency on the US dollar, but also supports more stable commodity prices, thanks to lower transaction costs and reduced exchange rate volatility. For everyday citizens, particularly in developing nations, faster and cheaper access to financial services can lead to improved daily living conditions, lower costs, and expanded business opportunities. In just 48 hours after the U.S. chip ban, Intel lost nearly $100 billion in market capitalization. The U.S. semiconductor industry finds itself in an unprecedented vulnerable position, causing the prices of technology equipment and services in the U.S. to soar. How much will American consumers have to pay for this technological standoff? On April 12, 2025, the Chinese government officially issued a ban on the use of US-made chips and software across all government agencies and state-owned enterprises. This includes major corporations like Intel, AMD, and Micron, with the goal of completely eliminating US technology from the national infrastructure by 2027, ranging from telecommunication systems, energy, to servers. According to Reuters, this policy aims to ensure digital sovereignty and reduce dependence on foreign suppliers. The immediate impact: within 48 hours, Intel's stock dropped by 18.3%, and AMD lost more than 11% of its value. The total estimated loss for US chipmakers could reach $350 billion by the end of 2027, according to Bloomberg. For Americans, this is a clear sign that the US tech industry is losing market share in the world's most populous market, threatening thousands of jobs and slowing down domestic technological innovation. Intel, the largest chipmaker in the US, is now facing unprecedented pressure. In 2024, 27% of Intel's revenue and about $22 billion came from the Chinese market. Immediately after the ban, Intel cut 20% of its workforce in the departments producing chips for personal computers and data centers. The construction of a major chip factory in Ohio, which was expected to restore the US's leading position in the semiconductor industry, has now been delayed by nearly a year, with the new operational timeline set for the end of 2026. The prices of computers and laptops using Intel chips are projected to rise by 12 to 17% next year due to increased production costs. Cloud computing services and AI infrastructure will also become more expensive, directly impacting the operational costs of small businesses and individual users. Financial Times analysts suggest that this is a domino effect that could slow down the digitalization process in fields such as healthcare, education, and national security. Not stopping at the US chip ban, China is expanding its strategy for technological self-reliance aggressively. Huawei has successfully manufactured 5mm chips without needing EUV equipment from ASML, marking a technical breakthrough for the country's semiconductor industry. Each year, the Chinese government invests over $58 billion into companies like Huawei and SMIC, providing support in finance, supply chains, and research. As a result, the share of chip imports from the US has dropped from 41% in 2021 to just 28% by the end of 2024. According to data from the China Semiconductor Industry Association Reuters, US companies are losing market share in one of the world's largest markets. Investment in chip manufacturing in the US is at risk of stagnating, leading to job losses in the high-tech sector. The cost of high-tech products in the US, from smartphones to AI computing systems, may continue to rise, contributing to the worsening inflation risk in consumer technology sectors. The United States has imposed record-high tariffs on Chinese goods. But the question remains, which side stands to lose more? While China responds with currency devaluation and redirects its exports, the world now faces the risk of deepening divisions. In the first quarter of 2025, the administration of President Trump imposed record-high tariffs, with some products reaching as high as 145% on imports from China, aiming to reduce dependency and pressure Beijing to make concessions on trade and technology. According to AP News, however, but as import costs rose rapidly, many small American businesses were forced to raise prices, cut staff, or withdraw from the market. A retail company in California reported having to pay nearly $630,000 more per year due to the new tariffs. A coffee machine that used to cost $120 has now risen to over $180. This has caused consumers to become more cautious in their daily spending. The ripple effect has also placed the Federal Reserve, the Fed, in a difficult position. If it maintains high interest rates, To contain inflation, it risks stifling growth. But if it lowers rates to stimulate demand, it puts pressure on the US dollar. By the end of March 2025, the Consumer Price Index, the CPI, had risen by 4.2% compared to the same period last year, the highest in 18 months. In this context, households with young children or elderly members are especially affected, as healthcare and food costs have surged. Immediately following the United States' decision to raise tariffs on Chinese goods to as high as 145%, Beijing allowed the renminbi to depreciate significantly. This devaluation made Chinese exports more affordable in global markets. According to a report from Bloomberg, in April 2025, the RMB-USD exchange rate dropped to 7.4290, the weakest level since 2010. However, Chinese consumers are now experiencing price increases of 10 to 20% on imported goods compared to the beginning of the year. Many households have begun to shift their preference toward domestic products. At the same time, China swiftly restructured its export strategy, redirecting a large share toward ASEAN and Europe. According to Global Times, in the first quarter of 2025, exports to ASEAN rose by 20.3%, especially in categories such as lithium batteries, auto parts, and consumer electronics. As for Europe, the World Trade Organization, the WTO, projects that Chinese exports to the region could increase by an additional 4 to 9% in 2025. One outcome of this shift is that many Chinese workers are now required to retrain and acquire new skills in order to adapt to changes in production lines, which may temporarily disrupt their incomes. According to AP News, in the first quarter of 2025, China's GDP grew by 5.4%, exceeding the projected 5.1%, largely due to a surge in exports prior to the implementation of new U.S. tariffs. Nevertheless, falling real estate prices and a 9.9% decline in property sector investment have raised concerns among many households. Asset values have dropped, and low inflation has contributed to a slowdown in the domestic consumption, although exports increased by 6.9%, enabling China to post a trade surplus of 1.96 trillion yuan in the first quarter. A 6% drop in imports has led many families to reduce their purchases of imported goods. In April 2025, the US dollar fell nearly 10% from its peak earlier in the year, marking its sharpest decline since 2022. The USD index dropped below the 100-point threshold, reflecting a weakening of global confidence in the dollar. Prices for imported goods, such as electronics and food, have risen. In addition, interest rates on home and consumer loans have also increased, making everyday living costs more burdensome. President Trump's trade and diplomatic policies are contributing to a growing divide between the United States, with Beijing tightening US dollar transactions and Spain turning toward closer cooperation with China. The global trade order faces a new inflection point. Is the United States losing influence in a game it started with historic tariffs? According to Bloomberg, April 2025, as trade frictions with the United States intensify, China has directed major banks to limit purchases of US dollars. This move reflects a declining need for the dollar in bilateral trade with the US and aims to reduce reliance on the global reserve currency while supporting the Chinese yuan, CNY, amid exchange rate adjustments. At the same time, Reuters reports that China is pursuing a controlled depreciation of the yuan to stimulate exports and counter the US's new 145% tariff, the highest since 1907. Spain has signaled a clear intention to deepen economic ties with China. In an April 2025 address, Prime Minister Pedro Sanchez stated, "No country wins a trade war. The greatest burden falls on workers and the middle class." Data from Spain's Ministry of Economy and the National Statistics Institute, INE, shows a trade deficit of $31 billion with China, primarily driven by imports of intermediate goods such as electronic components, machinery, industrial plastics, and chemicals, all critical inputs for Spain's manufacturing sector. As reported by El País and the South China Morning Post, Chinese automaker BYD has announced an additional $3 billion investment in Spain, bringing total Chinese investment in the country's automotive sector to $10 billion. The new funds will finance an electric vehicle and battery plant in Valencia, expected to create thousands of jobs and accelerate green technology development across Europe. Spain currently boasts the highest automobile productivity rate in the European Union, producing 13 cars per worker annually, compared to the EU average of 5, according to ACA 2024. Combining Spain's production efficiency with China's advanced EV platforms offers a promising competitive edge for both domestic and export markets. For Spain, attracting high-quality foreign investment from China supports its leading position in the automotive industry and advances its green transition without igniting trade conflicts with other nations. 10-year U.S. Treasury yields are hovering around 4.3%. As markets anticipate, the Federal Reserve may implement 4 rate cuts by 2026, bringing the benchmark rate down to 3%. J.P. Morgan analysts, April 2025, warn of a possible U.S. recession this year, projecting unemployment to rise to 5.3%, while core inflation remains elevated at 4.4%. In this context, bond investors risk negative real yields and potential losses if inflation surpasses nominal returns. Although protectionist tax measures may offer short-term gains for domestic industries, they've triggered cautious responses in financial markets. A reduced global demand for U.S. dollars, stemming from a decline in trade flows, could translate into weaker demand for U.S. treasuries, increasing borrowing costs and adding pressure to Washington's fiscal deficit.